Okay, so today we are going to go over the journal entries from the buyer's point of view when you're buying inventory for a merchandising company that sells merchandise. So the very first entry we're going to have is on March 5th, ABC Inc. purchased 800 units of product at a cost of $20 per unit. Terms of the sale are 210 net 60. The invoice is dated March 5th. Okay, so the very first thing you're going to do in every journal entry is enter your date. And then we're going to record the journal entry. And in this case, we're purchasing inventory to be resold to our clients or our customers. So inventory is an asset, and so in order to increase inventory, you have to debit it. Whenever you're purchasing inventory, it's going to increase. And the amount is going to be 800 units at $20 per unit, or $16,000. And then it says, so we purchased it with terms of 210 net 60. Whenever you see this, this means we bought it on account. So we've opened an account with whoever we're purchasing this inventory from, and they're allowing us to pay it. If we pay within 10 days, we get a 2% discount. If we don't pay within 10 days, then we have to pay the whole thing, or net, that's what the N means, within 60 days. So whenever you see these are credit terms, and that means we've purchased it on account. So that's always going to be accounts payable or a notes payable. Most of the time it's going to be accounts payable. And when we enter, when we purchase something on accounts payable, that means accounts payable is going to increase. So we're going to credit that. So that'll always be the account that goes last in the journal entry, is always your credited accounts. And it's going to be for the same amount because we owe the $16,000 to whoever we bought this inventory from. So you're going to record it for the whole amount, because at this point when we record it, we don't know whether we're going to pay within that 10 days to get our 2% discount or not. So we're going to record it for the whole amount, $16,000, like we're not going to pay it within the discount period. Then on March 7th, we find out that we returned 50 defective units from the March 5th purchase, which is this one right here, and received full credit. So if we receive full credit, that means we received the full $20 that we paid for it. So again, we're going to put the date first. And if we returned items and they gave us full credit, then obviously we're not going to owe the full $16,000 anymore. So we're going to have to decrease this accounts payable. So I'm going to put accounts payable here, because in order to decrease a liability like an accounts payable, you would have to debit it. And it was 50 units, and they gave us full credit of $20 a piece. So 50 times 20, we're going to get a $1,000 credit. Also, if we return the inventory, if we return these items, they're no longer going to be in our inventory. So we have to also decrease our inventory. Inventory is an asset. In order to decrease an asset, you have to credit it. Remember, with every journal entry, you always record the debited amounts first and the credited amounts last. With every single journal entry, always, always, always. And every journal entry has to be in balance. So I'm debiting 1,000 and crediting 1,000. And then it says on March 15th, we paid the amount due, taking the discount, because we're within the 10 days. Remember, we purchased it on March 5th. We're paying it on March 15th. So that's on the 10th day. So that counts. So we're doing a 2% discount here. Okay, but we're not going to be able to take the 2% discount on the whole $16,000 because we returned $1,000 of that. So we have to figure out what our discount is on the new amount that we owe, right? So if we originally owed $16,000, we returned $1,000 worth. So now we only owe $15,000. So if we figure out our discount amount, $15,000 times 2%, our discount amount is going to be $300. So the first thing we have to do, again, is record the date. This is March 15th. We need to take this accounts payable off our books now, because now we're no longer going to owe them. We're going to be paid in full. The original amount of accounts payable we owed them was $16,000, but they gave us a $1,000 credit, so now we only owe them $15,000. So in order to decrease a liability, you have to debit it, and debited accounts always come first. So it was the original $16,000 minus the $1,000 we returned and they gave us credit for, so we only owe them $15,000 now. That's going to take this accounts payable off of our books now. Going to show a zero balance that we owe the people now. Also, we're getting a discount on this inventory. So we're no longer going to be paying $15,000 for this inventory. We're really only going to be paying $14,700 because they're giving us a 2% discount. We always want our inventory to be sitting on our books at what we actually paid for it. So if we actually only paid $14,700 and right now it's sitting there on our books, right, at $16,000 minus a $1,000 return that we did, so it's sitting there at $15,000 right now. So we need to credit our inventory, because in order to reduce an inventory amount, an asset amount, you have to credit it. So that will be the $16,000 we increased it by, less the $1,000 we decreased it by when we did the returns, that's $15,000, less the $300 discount, so that would be $14,700. The inventory would be sitting there at $14,700 now. Then we have to figure out, okay, how much did we actually pay? Remember, every journal entry has to be in balance, which means that our debited amounts and our credited amounts have to be equal. And we already figured out that we're going to take a $300 discount on the $15,000 we owe them. So if we owe them $15,000 and we're taking a $300 discount, that's going to be $14,700. I've got $15,000 worth of debits. I've got $15,000 worth of credits. Our journal entry is in balance. Okay. And the very last journal entry from the buyer's point of view is on March 25th, ABC Inc. paid shipping cost of $75 for the purchase made on March 5th. So in order to get that inventory to us, we had to pay the shipping costs. So again, let's record the date first, March 25th. And the inventory needs to be sitting on our books at whatever we paid for the items plus whatever it costs to get it to us. So when you're recording journal entries from the buyer's point of view, that shipping cost is going to get debited to the inventory account to increase the inventory to show that we had to pay a cost to get that to us. So that's $75. And it says we're paying the cost. It doesn't say we're paying it later or the company billed us for the shipping cost. So whenever a journal entry says we paid something, that's always going to be cash, and cash is an asset. So in order to decrease an asset, you have to credit it. Okay, so the inventory should always be recorded at what it cost us to purchase it, less any returns, less any discounts, plus any cost that we paid to have it shipped to us. Okay, so that inventory that we purchased in these several transactions is actually going to be $16,000 minus $1,000, so that's the $15,000, minus the discount we got, so $14,700, plus the $75 we had to pay to get it to us. So that inventory is actually going to be worth $14,775. Okay, for that series of transactions. All right. And when you're recording these transactions, make sure you are using the journal entries, the chart of accounts that is provided down here. Okay. On all the spreadsheets that I give you, I'm going to give you a chart of accounts or a partial chart of accounts. Make sure you use these account names. In the homework spreadsheets, you'll have drop-down lists. I just didn't have time to do that here for these demonstration videos. Okay, so make sure if you're doing these demonstration videos that you're using the chart of accounts down here. I also included in the homework videos, so if for some reason when you download the video, especially if you're using an Apple product, sometimes the drop-down menus don't work, just come down here to the chart of accounts and make sure you use these exact account titles. All right, so those are the transactions from the buyer's point of view. The next series of transactions are going to be the same exact transactions, but from the seller's point of view. So this time we're going to look at it like we're the accountant that's selling these products to a customer.